Hello, Adrian. Earlier this month, the U.S. Federal Reserve joined the rate-cutting party. My first question is, what is the impact of this on the relative outperformance of international over U.S. stocks that we've seen year to date?
I think the U.S. still has competing narratives. We are trading at historically high valuations with a lot of expectations in the market. That's the Goldilocks scenario, right? Tariffs are a tax, so inflation won't be a problem. Consumers are hanging in because companies are absorbing the tariffs. And despite the hit to margins, businesses will continue to ramp CapEx and hiring as they bring production back to the U.S., driven by tax breaks. Benign inflation means the Fed can be cutting rates further and farther. With fiscal deficits, 6 to 7% as far as the eye can see, that implies a higher 10-year rate and therefore a steeper curve, which historically has been good for equities and GDP growth. Meanwhile, earnings growth in the U.S. does continue to be looking pretty healthy at around 10%. The alternative, though, is the three bearish scenario, where you've got the tariff price hikes, which are still working their way through the pipeline. You can see it coming into the PPI. It is hitting corporate margins. They have yet to hit, but they look like they will as companies pass on their costs because consumers have held in pretty well. Low-end consumers are starting to buckle. You're seeing that in delinquencies. High-end consumers, while spending, are cautious based on sentiment surveys. So maybe the retail strength that we've seen was just front-running of tariffs, and the consumer's about to pull back. Meanwhile, unemployment, no one's firing, but no one's hiring. You can see that because of the claims continuing to rise. Companies are holding back, meanwhile, in CapEx. They haven't started spending, right, and hiring due to the high levels of policy uncertainty. You can see that in ISM. You can see that in other surveys. Stagflation, meanwhile, therefore, would be potentially just around the corner, right? Persistent price pressures due to tariffs and supply chain disruptions, weakening earnings due to margin pressure, the Fed unable to cut because it has to make sure that inflation doesn't take off and become unanchored. So earnings growth today is concentrated exclusively in tech and financials. The rest of the sectors are flat to down, right? So for the US, you've got a ton of unknowns with a wide potential of outcomes at high valuations. So you're discounting Goldilocks, but the three bears could be there. Meanwhile, what is remaining the same? In international, you have the same set of fundamentals we talked about, where there are now alternatives and catalysts that did not exist 3 or 4 years ago to make European equities more attractive and Asian, particularly Japanese and Korean equities more attractive. What's happening in Europe? Fiscal stimulus we talked about before keeps getting bigger. German companies are now promising an additional $100 billion of investment on top of the $500 billion that the government is spending on infrastructure. Defense spending across Europe continues to ramp, with an increasing proportion now looking like it's going to European defense companies. Takes time to ramp up, but that is happening and will prospectively improve both GDP and earnings growth. So Europe is getting serious about competitiveness, right? They're cutting red tape in Germany, regulations, they're cutting taxes for business. No one is paying attention. And meanwhile, at 14, 15 times earnings with accelerating growth, we think that's an interesting place potentially for markets. Meanwhile, in Japan, we talked about it before, corporate reform continues apace. That is now being joined by Korea with its own program, which they call Level Up. What is this? Again, more shareholder-friendly policies taking hold, both countries. Good for return on capital. Denominator is shrinking as excess capital that was traditionally hoarded is now being returned to shareholders. Okay, that improves return on equity, justifies higher multiples, improves earnings growth. All of that is a positive at, again, very modest valuations relative to the United States. Meanwhile, in EM, you're seeing classic outperformance due to the Fed easing cycle and the expectations of more, like softer U.S. dollar, bringing back the carry trade, particularly in Mexico and Brazil. So there's a lot going on in international markets that are potentially of great interest.
I want to follow up on this softer U.S. dollar point. One of the big drivers of international stock outperformance has been that weak U.S. dollar. And with the Fed cutting, we might at least see on the short end rate compression, which might be even further bearish for the dollar. Is that your view as well?
So what we talked about last time continues. You have a completely different environment where the old world, where the foreign investors would buy the U.S. Treasury because they got much higher yields owning U.S. Treasuries 10 years than they got by buying JGBs or bonds. Right? That's flipped now because today, although it looks like the yields in the U.S. are higher, when you factor in the hedging cost of hedging them back into yen and euros, you get a much lower yield if you're a Japanese investor by buying US Treasuries. So you get more money, significantly more yield, by staying home and putting your money in JGBs or euros, or bunds rather, and therefore the reason for the structural overvaluation of the dollar really is no longer intact, because that logic is supported by the higher rate structure that really is no longer there. That's a really important point that I think investors miss, and really is a reason why you could see a consistent and persistent deflating of the dollar against other currencies as that math works its way through, and investors shift their preference to buying from buying U.S. Treasuries to buying JGBs and bonds.
Thanks very much for your time today, Adrian. Look forward to speaking to you next time.
Thank you.